Good morning, everybody, wherever you are around Australia. My name is Darren Xerri, and this is the Accountants Connection webinar series brought to you by Your Business First. Today, we've got Simon De Carro and Mark Pearson from Innovation Wealth Solutions, or IWS, talking to us today about how advisors and accountants can combine for better client outcomes. Simon and Mark have partnered with a number of accounting firms nationally, and I've asked them to talk to you today about not only about how to improve and form relationships with your financial planners and the financial advisory firms, but also the new educational parameters resulting from the Royal Commission and the Hayne Report that affects both professions. Before we get started, some housekeeping. As you can see on the bottom of the screen, there will be your there'll be a hand or in the Q&A. If you've got any questions that you like answered during the webinar or post the webinar, please feel free to write those questions. And if we have time, we'll go through them, and no doubt we will. And so we hopefully clarify those queries. So Simon, before we get started, can you tell us a bit about Innovation Wealth Solutions?
Good morning, everyone. My name's Simon De Carro. I'm the Managing Director of Innovative Wealth Solutions, which myself and my business partner, Leo Constant, founded in 2011. Leo and I met in 1989. We're fresh at primary school, and we've gone through primary school, secondary school, university, and gone into our professional careers together. Innovative Wealth Solutions, since founded in 2011, has expanded into the two offices in Camberwell and Thomastown, which are located in eastern and northern Victorian suburbs. And we now have over 500 clients, both locally and interstate. We've been able to build our client base organically. We haven't done what a lot of traditional financial advisors have done in the past in buying books. We've been able to organically grow our business through referrals through accounting firms and other professional bodies, as well as word of mouth through a lot of our clientele. We've been very lucky in that we haven't had to do much direct marketing at all. We've had a very, very good retention rate with our client base from day dot, and now we currently employ 10 staff locally and also offshore as well in the Philippines. Innovative Wealth Solutions was founded on the basis of providing a point of difference. We wanted to ensure that the focus was primarily on the client and their priorities were always held as number one. Whilst this has become law in the last couple of years, we've always had that sort of standpoint and viewpoint since 2011. And we always work to ensure that our clients' needs come first. So if that means we need to meet our clients outside of the office, outside of business hours, it's something we're more than happy to do so, and respect that our clients are good enough to provide the loyalty and ongoing consumer sovereignty to our offices based on this rationale. At the same point in time, we are a very boutique business. Like I said, we don't do a lot of direct marketing. We don't get a lot of foot traffic coming off the street. This is why we have a very, very specific target audience. But at the same time too, don't say no to many investors and clients going forward. We do have quite an extensive level of experience and a good reputation in the industry. We're licensed by an independent financial advisory board, which means that, especially in the light of the Royal Commission recently, we don't have issues such as vertical integration or oppression for sales tactics at all. Our adage at Innovative Wealth Solutions is strategy first, product second. And given that we've got a very extensive approved product list, it means that we can broker the needs of our clients with the needs of the product to ensure that the outcome, which is at the sole focus behind our clients engaging with us, materialises in the future. So going forward, I'm going to introduce Mark now to talk about what a good financial advisor basically does going forward.
Thanks, and hello everyone. My name is Mark Pearson, as Simon introduced, and yeah, I'd love to talk to you a little bit about what a good financial advisor does. So we would like to include ourselves in that category, and we think that what good financial advisors are essentially life advisors. So really the first step, what we do when we sit down with a client, and what good financial advisors should do when they sit down with a client, is really work out what their life goals are. Because The thing with money and the thing with financial planning is planning tends to be very successful if you get the reason why behind it well. What a lot of clients tend to do and to get themselves into financial trouble is they're trying to do too much too quickly. They're trying to build wealth because they feel like they have to, and they haven't really properly blocked out what they want their lifestyle to look like and what they want their future to look like, because you can't put the right financial plan in place unless you really know where that final goal is, because you can put a $1 million retirement price tag, a $2 million retirement price tag. It doesn't really matter what that top of the mountain looks like if you don't know what mountain you're climbing. So the first step is you really have the right discussions around what clients want in their lives. And then once they know that, we use things like investment advice, preparing for retirement, insurance, and superannuation advice as a pretty helpful block to help make those life goals come true. So once you have your life goals accurate, the right path to building wealth becomes easier to plan and easier to maintain, because any plan that you put in place involves sacrifice, and most clients won't make that change, won't make that adjustment if those goals aren't real. So some will tell me they want an investment property or they want X or Y, but no real basis behind why they're saying those things. Think they have to, or I think they should. And then the other side of it is not only making sure that we set the plan, but a good financial advisor will make sure that they are also there as life starts to happen. So not just the implementation of the plan, but then helping them maintain it as things start to happen to them, as their wants change, as potentially divorce, life things that happen, to make sure that plan actually comes to fruition. Because the other thing that we've noticed is clients that are coming to us for a specific thing, it's usually involving change and modification, and that is difficult to do on your own. So we help them with the structure and strategy, and then we also help with the consultant and advice basis as they continue to play that strategy out with the problems that arise. We also think that quality financial advice needs to be flexible for changes in the economy, the political structure, anything legislative as well. So what a good financial advisor is there to help you set up, and then also to help you maintain as the chaos of the world follows through. And the other challenge that we're rising to is the advice industry is actually in a period of great change. So once you've got your good advisor, they also have to go through all of the stuff that we're going through now, which mainly came out of the Royal Commission. So as most of you will be aware, the Royal Commission finished, final report was in Feb this year, and it made a raft of changes. And the ones that really affect the advice industry, and also potentially accountants as well, is that there are now some educational minimums, and there's also a national exam that needs to be completed. So the Financial Advisor Standards and Ethics Authority, or FASEA, they are the body that is overseeing the increase in educational standards. So for accountants that are currently giving advice, you will most likely be RG 146 compliant. If that is the minimum standard that you have, then you are now required to do 8 units of study to get up to standard of the base level. So you've got until January 2024 to do it, but even more pressing is the exam. So all financial advisors, new or existing, need to sit a standardised exam between now and January 2021. And if you don't pass that, then you can no longer provide advice after that time. And so given that this webinar is about the importance of accountants and advisors working together in the future, if this is something that you're facing to having to go through to provide financial advice in the future, it's going to be a logistical nightmare for you to do full-time accounting work and to also meet these standards. Someone wants to say something.
Just to reinforce some of Mark's comments, with the Royal Commission, obviously, consumer confidence in the financial services industry was an all-time low. And what FASEA are looking to do with these increased educational parameters is to build consumer confidence, but also at the same time too, try and make the title of financial advisor deemed to be more professional. So the 8 units, which Mark was speaking about previously, is basically a tertiary equivalent degree. So whether it be commerce, whether it be business related, it has to fall in tune with what financial advisors are basically doing. So regardless of whether you had a a financial advisor that's had 50 years of experience, if they don't have a relevant tertiary-related course at this point under their belt, they have to do a tertiary equivalent exam and the modules associated with that. So what we're finding is that with the new enhanced educational parameters, it's likely in the next 2 to 3 years that there will be a drop in advisor numbers nationally of up to 40%, which is quite daunting, especially when you don't have the same intake of financial advisors going through tertiary education to become qualified advisors. And at the same time too, we're finding that new entrants into the industry need to go through a year of supervision, professional supervision. So it's almost like an experience year before they commence. Sorry, no.
No, all good. And so this is all leading to a path where when these educational standards go through, you're going to get left with a surety that the advisors left have a very high standard of knowledge and really know what they're about in terms of their trade. In terms of accountants, that probably means that if you are currently giving advice yourself, then most likely you're going to, unless you want to go through all the education standards and requirements, then you're going to look to partner with an advisor. Now, where it gets tricky is how do you select an advisor and how do you select an appropriate advisor for your business. So I'm going to throw to Simon now, and he's going to talk to you a little bit about how establishing that relationship with the right advisor can enhance your business. And then I'm going to come back and talk to you about how it's going to enhance your clients' outcomes. Over to you, Simon.
Thanks, Mark. So in terms of efficient relationships between the advisor and accountants, it's a fantastic synergy that accountants and financial advisors have when working very closely together. For example, a lot of accountants have their specified skill sets, which we as financial advisors can't even touch on. In the case of Mark and I, we're both practicing tax practitioners, but we can only really touch on the topic of tax. And it's really more of an introduction to a qualified accountant that we can do. We cannot, for example, lodge any tax returns. We've got to be very, very careful due to licensee parameters, especially in this day and age of high litigation, of what we can and can't say. At the same time too, as accountants, it's very difficult, unless you're holding an RG 146 or a similar qualification, to speak about financial advice as well. The line in the sand is very, very clear. You can get into a lot of trouble if you encroach upon those restrictions. We find that in terms of having a good working relationship with the accountant, it does enhance the experience which our clients have. If best practice for us is sitting down in the room at the same time too with the accountant and the client present and discussing exactly what the needs are, what the objectives are with the client, and what they're currently doing at this point in time. And we're finding that because the relationship's so strong and everyone's sitting down and on the same page, the client retention over time is strengthened. Having a very, very good relationship between the two disciplines certainly ensures that the Chinese whispers of one person saying something to some person, then saying something to another person, and the message being diluted in time is greatly mitigated by having those meetings where everyone's crossing one page.
So, Simon, how often do you think the accountant and the financial advisor should meet with the client and at that same time?
Look, in an ideal sense, it should be probably annually. But depending on our service agreements, and we have service agreements that go from anywhere from a quarterly meeting to an annual meeting, it should be at least annually. But if there's any changes in circumstances which are material, it should also warrant another meeting at least. We find too that in terms of the increased scrutiny of the Royal Commission and so forth, this is best practice going forward, in that the financial advisors are talking about what they're capable of speaking about and what they're experienced in speaking about, and the accountants are also speaking about their greatest strengths as well and the expertise that they've been able to hone over the years. That way, when you've got a good relationship between the advisor and the accountant, that level of trust which the client has in the two professions, that their best interests have been maintained, is galvanised even further. And we've found that a lot of the relationships and the clients that we've formed over time, it's been, the longer that the client's been with us, it's generally been when they've had an in-house attached accountant or financial advisor working in the same room at the same time together. Now, in terms of how partnerships can enhance client outcomes, Mark's a specialist in this area. He'd like to take the next presentation for us.
Thank you. So as Simon pointed out, these relationships can enhance your business, but obviously what we both care about and what advisors and accountants prioritise is the well-being of their clients. So I want to speak a little bit about how client-advisor partnerships can enhance the actual client outcomes. And so while we're a very strong believer that every client who's navigating a successful financial journey needs to have a various number of professionals at their table advising them about how to make decisions when they come up. And so two of the most trusted, if they're successful, are the accountant and the advisor. And so the advisor is obviously worried about maximising your wealth, and the accountant is making sure that you don't run foul of the ATO and then hopefully pay as little tax as possible. And so we both have the same best interest outcome for the client, but it's coming from different views. So as new opportunities come up, as new plans come up, it gives you an opportunity to run it through some different perspectives to make sure they definitely get the right answer. We also make sure that by having these partnerships in place, the accountant particularly becomes a centre of influence for the client. So what you want is you want your client coming back to you when they're looking to make new financial decisions. You want them to look at you as more than just their tax agent, and I'm sure that many of you have that relationship already, but you want them to approach you, and then you have some solutions to pass them on to other professionals that you know that when you refer them, they're going to be treated the same way that you treat your clients. And that is very important, and that only comes with a trusted network. The other thing that really helps, especially from an advisor point of view, is when we're going through the planning process, sometimes clients don't have the most accurate information. So being able to have an accountant that we work very closely with the client, it means we get very accurate information, because if we don't have accurate information, then we can't give solid, accurate plans. And vice versa, when it comes to the accountant side of things, when you need to calculate the consequences of tax, again, clients might not have the exact knowledge of exactly what they're doing. They'll have a very good overview, but in terms of the information that you need, having a smooth process between accountant and advisor can make that process much more faster. The other part that we make sure is, again, when it comes to spitballing decisions. So when the clients are making their big decisions in life, they're going to have some people they know they can approach, and they're not relying on their uncle at the barbecue. And what we then see that is the best possible chance for the right outcome is if they've got the ability to get the right perspective. So having those different perspectives from trusted sources means that they've got the better chance of navigating this thing successfully without making the big mistakes. Now, so now that you get that, and we can see that how we're going to enhance a business and enhance client outcomes, we're going to give you a little bit of advice about how to select the right advisory firm for you, and I'm going to throw to Simon for that. Over to you, Simon.
Okay, so in selecting a good advisory firm, things that you need to look out for is ideally, and this has again been highlighted by the Royal Commission, is that the advisor shouldn't have conflicted sort of advice processes. That being that the advice should be independent. It should be at the client's needs first. This will enhance the integrity of the two firms and ensure that the reputation of both firms is maintained and intact over the years. Where you've got a culture of sales and sales only, we're finding that these types of practices are really getting scrutinised very heavily by ASIC, by APRA, and a lot of the regulatory bodies which govern our industry, for example. And the last thing you want to do is have your reputation and your name tarred with the same brush. It's also important too to consider the size of the company you're dealing with. For example, if you're running a medium-sized firm and you're trying to engage a smaller more boutique advisory firm to look after your clients, volume might become an issue in the future. So for example, they mightn't be able to handle 2, 3, 4 plus clients a week, and find that the client experience as a result is diluted and can cause issues in time, which adversely affects the reputation which you're trying to maintain. Another important aspect to consider is that the shared values of both practices are also maintained. For example, if you've got a churn and burn type philosophy where clients aren't being looked after, and it's more about sales and getting through as many clients as possible. Whereas conversely, you've got a practice which has a philosophy of looking after the client's needs and is more nurturing, then there might be an issue in time going forward. Having both practices on the one page just means that you've got consistency in front of clients, and again, that experience from the investor and client's eyes is always more positive rather than negative. With social media these days, with Facebook, Instagram, with Twitter and all the other various social media abilities to collect data, it's important too that you're looking into and investigating practices which you're looking to align with. It's very, very easy to determine through a Google search, for example, whether or not the advisory firm that you're interested in has a track record of doing the wrong thing, or has skeletons in the closets in terms of former breaches or unsavoury staff being employed. Ensuring that you're dealing with the right people, again, helps galvanise your reputation going forward, because you're only as good as the referrals that you're sending to the referral party. It's also important too that you have very good agreements between the firms, because at the end of the day, you need to know exactly where you stand. And that's where it basically leads to establishing a very good referral agreement. Now, referral agreements, depending on the practices and depending on the relationship you're trying to galvanise, will depend on whether how formal it needs to be or informal it's going to be. Handshake agreements can work if you've got very, very good relationships standing the test of time and the trust is there. But generally, best practice is to have a formal agreement set up appropriately through a solicitor or lawyer. That way you know exactly where the firms stand in the event of events changing, and also in the events of scenarios popping up which haven't been considered properly previously and have very loose ties. Client ownership in this referral agreement needs to be very, very strongly worded and galvanised, because if one firm decides to refer a client to another accountant or another financial advisor, this could lead to a breakdown in the referral relationship. This is not a place you want to be. From experience, what we do in-house is that with our database, we ensure that we've got a very, very good understanding of where the client has been referred from. And in not wanting to step on toes, we always ensure that we never refer that client to another accountant, another lawyer, or someone else in conflict to who the referring partner was. Also, what we tend to do is we get referrals from that client that's been referred from the accountant originally. We refer those new referrals back to that point of origin to ensure that everyone's on the same page and there's a consistent service arrangement in place. The referral agreement should also work out what motivates both practices as well, whether it be a shared commission basis or whether it be an informal referral for a referral basis. Depending on the relationship between the practices will basically determine what works best for you. But in the past, we've found that referral for referral takes away any conflicts of interest and ensures that we're not having to make extra disclaimers to our clients on the basis of that rationale. At the same time too, it's important that both parties identify their ideal clients as well. So for us, our referral partners know exactly what we specialise in and what we're looking for as an ideal client. And it's important too for us to have an understanding of the accounting firm's needs too, in terms of galvanising future relationships with them as well. So ideal clients and having that understanding is paramount to having successful referral relationships going forward. And two, I would always encourage that there's frequent meetings between the two practices to ensure that people understand what's worked well in the past, as well as what hasn't worked well in the past, and you have that work in progress sort of report between the two practices to ensure that going forward you're enhancing the relationship between the clients as well as the accounting and financial planning firms.
Just one other thing I'll touch on before we move past, just in terms of selecting the right advisor. You can use social media, or you can use the online view, but I would encourage a rigorous interview process. So one of the things that we are very strong on, that we know accountants are even stronger on, is protecting their reputation and the welfare of their clients. And so you want to make sure that any partnership that you enter into is with a firm that really does put the client's needs first. So you want to test them to make sure that they are a service-based advisor. So touching on what I said before, if you want your clients looked after, you want more than what they call a transactional advisor. Sometimes you might need some transactional work done. You might just need an insurance policy put in, or some one action. But usually if you're going to engage an advisor, it's over a longer period of time. So make sure the advisor is a service-based, make sure they're very clear in everything they communicate, that they're not chasing the dollar first, and they actually have they want what the client wants, which is what the client wants. And so that is very key, because we appreciate how hard it is to build a reputation and how easy it can be lost. And when you refer somebody, you are essentially extending your reputation to that advisor. And that's not something that we take lightly. And I know it's not something that you take lightly. And so you want to make sure before you even get to the referral agreement stage that you've got some advisors on board that, yes, have a commercial reality, they're building their business, but it's based off the back of getting the clients what they want, and not based on revenue collection first. And that can be borne out if you make sure that the interview process, and making sure that when you engage an advisor, you're not just asking these questions, but you're taking your time to make sure that you can assess the type of people you want to work with too. Because successful advisory firms that are there for the long term are the service-based advisors, and are the ones that put the client's needs before anything else, which is one, a legal requirement, but two, in terms of it is gold standard in terms of what you'd be looking for in an advisor.
At the same time too, folks, as well, it might also be worth your while inquiring about the new legislation, and whether the advisors which you're looking to partner with will take on board those extra parameters. Because with the parameters being quite high these days, they might only have a very short window before they're no longer compliant and looking possibly at selling their book and exiting the industry itself. So ensuring that they've got longevity, they're investing back into the business, and looking for opportunities that are going to arise with this new change in circumstances. It's important to galvanise and understand exactly where that's coming from too.
That's great. So, just before we continue with questions, please be reminded that under the Q&A box there on the bottom of your screen, please feel free to ask a question. We've had a couple come through so far, but if you've got anything that's on your mind, or you want to clarify a bit, just please feel free to enter that information. And when I come to pass on that information to Simon and Mark, I'll make sure it's done anonymously. But one thing I did get out of it is that how important it is from a FASEA and from the education requirement point of view. The accounting firms I've been working with most in my career is that they do take on a lot. And as far as the financial planning side, or the service side that they're offering those clients, and with the implementation of the new education requirements, that's just going to be a whole lot more work for the accountants to take on, and whether or not they do want to take that on. So as far as the partnering up with a financial planning practice, I think that's something that really needs to be considered by all parties in relation to what is the plan and what is the goal moving forward. So thanks very much again, Simon and Mark, for presenting today. I've got a couple of questions that have come through. So one is, I suppose, how do you get clients to switch to the accountant's preferred financial planning firm? And I'm assuming that question's asked because that accountant is not happy with the advice that financial planning firm is providing their client.
Thanks, Darren. I'll take this one. I would start by first asking them some questions about their relationship with their existing financial planner, assuming that's where they're starting from. And that would be around how much contact they get, how much fees they're paying for the service, and what the overall detail of the service package they've got with their advisor should be. Because again, in this new FASEA world, one of the things that you're going to have to keep a keen eye out for is fees for no service. So again, we personally think that financial advisors that are doing a good job are going to be someone that are going to be in regular contact with these people. And so if your client hasn't seen them in at least like maybe longer than a year, they haven't catch up with their annual review, or they only hear from them when they have to get a fee disclosure statement, these are all things that you might be able to challenge as a basis for maybe seeing another financial planner. And I would even encourage it as a starting conversation, just as a second opinion. We're very happy, and we do it all the time, to have a first appointment for free to analyse their client situation, and then it might be that their health check is fine and we walk away. But at least giving them the opportunity for that second appointment with no obligation and no commitment to making any moves will give them another perspective, because they might not know what they don't know. And so if you are looking to potentially, or you think that the client could do better, I would start by going down that track of asking, what their relationship is, how often they got contacted, what kind of work they're doing. And if you see any obvious gaps there, then that might be a bit of a primer to start that conversation. But yeah, I would recommend a second opinion appointment, then just see where it goes from there.
Okay, yeah. And as far as preparing a financial plan, we're talking about objectives and the actual, what the client has got in mind for the next 5, 10, 15, 20, maybe even 30 years. When we do prepare a financial plan and talk about the objectives with the client, from your experience, how often is the plan revisited, and how often, or what time frame do you give the longevity of the plan? Is it like, for example, 20 years with a revisit of every 2 or 3, or is it a 5-year plan, then we start again type thing? So can you just clarify that?
Certainly. Thanks, Darren. Well, in terms of the financial plans and interacting with our clients, obviously every client's different. So it's very difficult to ascertain and give you a blanket answer. But what we like to do with the financial plans and strategies is at least provide a flexible plan to start with. Because what we find is that circumstances are definitely going to change, whether it be political, economic, personal, financial. There's just changes are given. It's going to occur. We like to have a very trusting relationship with our clients, and we'd like our clients to contact us should anything change or any circumstance arise. So it really depends in terms of the engagement model which our clients are looking into, but it can be anywhere from a quarterly catch-up to an annual catch-up. It's all dependent now on the fee schedules going forward and the engagement roles, which now we have to, as advisors, adhere to.
And we do help determine that throughout the planning process. So one of the things that becomes apparent as you move through our process is how much contact we really need. So when someone says it is variable, it's because that, again, no two plans are the same, and individual clients will need individual contact schedules. And so, yeah, it does fall quarterly, half yearly, or annually, usually as the 3 standard. And that depends on how fast they can move, how much surplus they have, what they're trying to achieve. So all those things factor in to getting it, because we don't want to be seeing them too often and then they're not getting value for money either. So we do work quite closely to make sure that our contact is appropriate to the plan.
But having said that too, the level of sophistication and financial knowledge some of our clients have varies greatly as well. So we Mark, myself, and the staff at Innovative Wealth Solutions would prefer us to be seen as educators rather than just people collecting commissions like every other financial advisor. Our point of difference is that we like to educate, explain things in very easy to understand language, so that our clients are getting a very, very good, clear, concise, and understanding point as to where they currently are. We don't want our clients confused, losing sleep at night, having engaged us as advisors. We want them to have peace of mind, knowing that everything going forward is managed for them, and that their goals in time will materialise if they steer to the path which we're recommending to them. And that's effectively where we stand.
Okay. Simon, before you were talking about the key things to look out for when partnering with a financial advisor, and you're talking about the track record and reputation. So if I'm an accountant or a partner in an accounting firm wanting to form a relationship with a financial planner or financial planning firm, as far as a track record and reputation is concerned, how do I go about involving that as part of my due diligence? Where do I go and what do I need to do?
Absolutely. with social media being at the forefront these days, word gets around very, very quickly. So we find that having a good reputation helps, but if you've got a really, really bad reputation, we've seen this with other financial advisory firms, it's very quickly banded across the industry. Our industry is very small, and it's likely to get smaller again going forward with the new educational parameters. But I'd be engaging in a quick Google search of the firm, directors, managing directors, at the same time too, having a look at LinkedIn, getting an understanding of who these people engage with. We would generally say that if they're engaging with the wrong people, it's likely that they've got skeletons in the closet.
Okay. That's basically it.
No worries.
Yeah. So I've got one more question here that's come in, and actually it's come in twice from a different attendees. So there are some accounting firms out there who would like to start up their own financial planning practice and getting a financial planner involved. Probably a two-part question. Is that one? Do you recommend this? And if you do, what should they look out for, and what do they need to consider if they're going to start up a financial planning firm in their own right with that financial planner?
In terms of setting up a financial planning firm in-house, that's not an issue, but it is going to require a fair bit of investment. One of the first aspects to look at really would be the proper selection of a licensee, which these days is becoming increasingly difficult. We're seeing with the Royal Commission licensees such as Dover, AMP, a lot of the banking-based licensees have been dragged through the coals, so to speak, due to vertical integration and having conflicted commission reports and so forth. In terms of staffing those financial planning divisions, here too you've got to be very careful in selecting the right individuals to be heading up those divisions. What we're finding at the moment is that with the increased scrutiny and educational parameters, a lot of the cowboys that were basically holding on to their licensees by the skin of their teeth will be soon removed, as they no longer really want to go through the increased educational parameters, which are becoming the real scenario going forward. So I'd be looking at, one, selecting the right licensee and being very, very careful with character checks and having financial advisors which have come from good stock. I wouldn't be looking, if I was in that position, looking at necessarily bank-backed financial advisors in the past. You can have issues running with culture, running with conflicted motivational values, that's for sure.
Okay. Right. Okay. I've got no more questions that have come through, so we'll probably proceed. So thank you very much for providing those questions, everyone. That's been great and helpful. So to close off today, there's been an offer that Simon Mark have put to all the attendees today and the registrants to this webinar. They want to meet you, and we hope that you want to meet them. So see for yourself and book an obligation-free session, and experience the appointment with an IWS advisor or Mark or Simon. So there is a 3-step process as usual when it comes to our webinar series. If you want to find out a bit more about how you can work with Simon and Mark, just email me your contact details to inquiries@yourbusinessfirst.com.au. That's inquiries@yourbusinessfirst.com.au. And I'll get either Simon or Mark to contact you to book a time. Have your questions ready, have your thoughts ready and scenarios, and they'll organise a meeting with you, and just to see how IWS can help you. So this is a great offer that they're putting forward today. I strongly suggest to take up this opportunity to do so. They're a great bunch of guys, and the officers here that work through are great, and they're very, very educated in what they do. So thank you very much for your attendance today. I hope you got something out of it. Again, I strongly encourage everyone just to make contact and speak to Mark and Simon. There are the details there on the screen, and enjoy the rest of the day. And keep in mind and look out for the next Accountants Connection webinar series coming up in the next few weeks. Have a great day.